So we have our special contributor, Larry Summers of Harvard. Larry, thanks so much for joining us. We heard from Jamie Dimon after the First Republic that he thought pretty much we were over. Maybe there'd be a small lender left. Looks like we're not over this, whatever it is right at this point. How did we get here? Why does this keep going on?
Look, David, I think that we actually are probably over the vast majority of the banking traumas. But look, we still have institutions that have looked vulnerable for some time, and those are the ones that are most affected today. We still have concerns about commercial real estate and what that's going to mean for the creditworthiness of a number of institutions. The circumstances surrounding First Republic with the big deposit from the big banks and with the role J.P. Morgan was playing are in some ways unique. So there are still questions that are going to be around. But I think we should keep some perspective on this, and people should recognize that there's every reason to expect that deposits in the banking system will be money good. I do think that the government has shown that when institutions are mismanaged and blow through all their capital, that their shareholders are going to get out with nothing. And, that is the right thing, and it's probably exerted some bit of negative impact and raised the perceived riskiness of being an equity investor in some of these banks. But I'm concerned today, but I have to say I'm not highly alarmed by what's happening in the banking sector. I'm frankly more alarmed about what's happening in the political sector, where it's clear that we've only got a certain amount of time and something's got to come together or something very serious is going to happen.
So I want to come back to that. There's a very important point with Janet Yellen, the Treasury Secretary, saying yesterday, maybe June 1 actually is the X date. But before that, is it a matter of mismanagement? Because clearly some people are saying there has been mismanagement, no doubt. But is there a more systemic effect here? Because we have a lot of banks, it appears. I've seen some reports, maybe half of the U.S. banks actually have liabilities greater than their assets at this point because of the reduced value of the assets, because of the rapid increase in the interest rates. Is there a larger issue of solvency with respect to a lot of U.S. banks at this point?
Look, I think we are going to need to do some very careful thinking about marking bank assets to market and assessing the value of assets in more real ways. But I think there is some alarmism in the calculations you're describing, because it insufficiently recognizes that, yes, if you hold a bond or you hold a mortgage and the interest rate goes up, the value of that mortgage goes down. But equally, if you're having a deposit and that deposit is at a low interest rate, and so you're going to be able to earn a spread, there's an asset there, and when interest rates go up, the value of that asset goes up. And so I think it's kind of alarmist and wrong to focus on the first adjustment and not pay attention to the second adjustment. So yes, absolutely, we have not been as careful in thinking about interest rate increases as we should have been. I think it was kind of amazing and very unfortunate that Fed stress testing didn't put weight on interest rate increase scenarios in the way that it should have, and that's an important intellectual failure by the Federal Reserve System. But I also think that the kind of analyses that you're citing are probably overly alarmist with respect to the risks that are in the system.
Lawrence, let's come back to the issue raised by the debt ceiling, because it does seem to be that there are alarm bells literally going off in Washington, even as we speak. You've been in these jobs when there's a crisis, and sometimes they come in pairs. Right now, we have the banking on the one hand and the debt ceiling on the other. How do you handle those simultaneous potential crises?
Well, you tell your family that they're not going to see much of you for a several week period, and you gear yourself up for a very tense kind of period, and you remind yourself that it's very important to speak with great care, because the most important asset a financial policymaker has is her or his credibility. And so you choose your words in those situations very carefully, and you try as hard as you can when you think you've come to a course of action to ask everybody around you, what should I be worried about? What could go wrong here? And you try to minimize as much as you can any possible risk scenarios associated with the course that you have set. And you do that, and then you hope for the very best. I think the issue that's particularly difficult right now is not so much the banking issues, as difficult as they are, David, but I think on the debt limit issue, you have parties that may not always be rooting for success. And you also have entities like the Republican caucus, where you're negotiating with somebody, but you're not really sure of what the person you're negotiating with can or cannot deliver. Right. And that makes this a more difficult kind of situation. The other thing you do, which you don't talk about, is you contingency plan for all the scenarios. And, you know, it's interesting, if you look at the minutes of the Federal Reserve System from 2011, they had very elaborate scenario planning to keep things going in case there was a debt limit failure.
Well, let's talk about the Federal Reserve. Since they're having meetings today, we're going to get a decision tomorrow. How does this affect potentially their decision? In the past, you said you think 25 basis points is in the cards for May. Can they hike into a banking crisis?
Obviously, they have to pay attention to the banking system. I don't think what we're seeing in markets today should be an impediment to their hiking in May. Anyone in the Federal Reserve System who was inclined to use language that was committing to further hikes in June should surely hesitate, because we don't know how this is going to metastasize. At the same time, I think for the Fed to signal in a definitive way that they were finished would be to take a substantial risk of locking into what turns out to be a mistaken path as things appear a week from now, and would also perhaps be taken by the market as a sign of significant alarm. So what I'm going to be looking for and hoping for from the Fed tomorrow is a move upwards and a clear recognition of uncertainty and agnosticism with respect to what's coming. Because unfortunately, I don't think the Fed can take much off of its worry list. It's got to be worried about inflation still, given the recent inflation statistics. It's got to be worried about what's happening in the banking system. And it's got to be worried about what the developments in terms of the debt limit conflict are going to mean.
Right.
So I think it's a pretty sober group that's likely meeting as the Federal Open Market Committee today.